What's going on, everyone? On a morning walk this morning with Ruby. We're here at the little lake thing here in the neighborhood where we live. Going on a little walk out here. It's super nice. It's getting really cold here in Texas now, really frigid. So Ruby's been loving it, and I've got to wear my beanie and my jacket and stuff now. So here in today's video, we're going to talk about how can you be right more often in your trading? How can you increase your win rate? Increasing your win rate does two very important things. Number one, it usually increases your profitability. If you have a higher win rate, provided your risk rewards are decent, like 1-to-1 and up, if you have a higher win rate, you're typically going to be more profitable. Second thing is it really improves your psychology. Why? Because if your win rate's generally high, if it's like 50, 60, 70% and up, it means your losing streaks are probably not going to be that bad. So it's not going to be very taxing on your psychology. And it also means you'll get those really cool winning streaks. And especially if you're on a winning streak of like risk rewards of 1-to-1, 1-to-2 and up, it's really good on your psychology to just have a decent win rate. So let's talk about how you can increase your accuracy on your trades, what you can do to be right more often. If you're a subscriber here to my channel, make sure you hit the like button to support the video. And if you haven't subscribed yet, watch this video and then check out a couple of my other videos and consider subscribing. I release videos like this where I talk about my life and trading, as well as how you can sort of do the same. Let's get started. All right, so here we are in my office. Now, how to easily increase your win rate. We're going to be covering 4 super simple, straightforward, yet very important things. The first thing is that you need to have a set of basic rules to give you a framework for what you're looking for in your trading. 2, looking at multiple outcomes for things that could happen instead of just looking at the one outcome that you think could happen on the chart. 3, waiting for the appropriate price action to align with what your analysis is before you get into a trade. And 4, using a little bit of intuition that you get as a result of applied experience in your trading to help guide you in trades that you should take and also trades that you should stay out of. All right, so an example of a set of basic rules that you can have is right here. 1, we can wait for a break of a clear H4 horizontal level. 2, we can wait for price to come back and retest that level. 3, wait for price to begin rejecting the level. And 4, we'll simply place a trade to profit from price bouncing away from the level. This is super simple. It's just a simple break and retest system. If you have a support level, like for example right here on the chart, you'll simply wait for that level to get created. You'll wait for it to become super clear, super obvious. You wait for it to break, retest, and if it starts bouncing at that zone, you'll look to take a sell. So you're profiting on price bouncing away from the zone. So this is a framework for a super simple approach to creating a trading system that you can have a couple rules in place to help you know what to look for. Your rules can keep you safe. For example, if it's a level like this here on the chart, where price goes in and out of it a bunch of times, it's probably not the best level to use. If it's a level like this here on the chart, where price sometimes reacts as support and sometimes reacts as resistance, but there's been many swipes through it over and over, then it's probably not the best level to use if it's not that clear. Another example is if price comes to retest that level after breaking past it, and let's say it hits the level, rejects it just once barely, but then spikes up through the zone and just continues ripping upwards. This happened today on some trades we were looking to take here at Mission FX. We were looking to take sells on GBP AUD, but price ended up, instead of rejecting the level, ended up just spiking above the zone, coming and testing as support, and then pushing away from the zone to the upside. So making sure that it's a clear zone and also making sure that there's rejection at the zones end up for better trades. Keep in mind, your rules are here to guide you. There will be instances on the chart where things don't set up exactly perfectly and you will have to decide whether or not the trade is still worth taking. Rules provide a framework for how you can go about placing trades. Just a reminder to hit the like button. That's what we're here for. We're just a reminder to hit. Number 2, looking for multiple outcomes instead of just one. So whenever you're about to take a trade, we all have an idea of what we would like to happen. We would like for price to come to a zone that has been bouncing as support. We would like to see it break below and come back and retest. But what about price if it retests that zone, starts to drop, but then pushes back above and starts finding support on the other side? This would still technically fall into the category of a trade we could take because it is a break of a zone, it is a retest of a zone, and it's rejection of the zone. This can do 2 things. Number 1, looking at multiple outcomes can allow you to stay out of trades that might not be the best trades to set up based on what price is doing at the levels you're looking to enter at. And number 2, it can also allow you to place trades that you otherwise wouldn't have been able to profit from if you're able to look at the other side of the coin, or in this case, multiple scenarios. A perfect example of this was on GBP AUD this morning, whenever price came back into this zone and we were looking for rejection. Since there was literally no rejection at all here at this zone and price just pushed above it, what we were doing is, number 1, we didn't take sells. We left it alone. We didn't take any
trades. Number two, we were actually looking for buys if price were to come back in here and test this zone a second time. Because if that would have been happening and we would have seen rejection candles, something like this, that could have given us enough evidence to say that price is probably going to bounce off this zone and then continue up to whatever it is the next zone is. Very simple, just trading from zone to zone using price action and watching what price is doing to give us evidence to see what is likely to occur next. And you can profit both ways. If price comes up and starts rejecting this zone, sweet, it would have been a great trade. But what about the other side of the coin, the other outcome that could have occurred in case this outcome doesn't work out? Price could just as well break above the zone, come back and test the other side of it, and then start continuing away in the original direction. It's good to look at multiple outcomes because it keeps you open-minded and it prevents you from thinking just one way. The biggest way that this helps your personal trading, from my experience, is it keeps you out of trades that are otherwise trades that you probably shouldn't be taking. It keeps you out of trades that are sketchy, that are bad, that are unclear. Being able to look at this and being able to look at what could happen, what the other outcomes are, and if those other outcomes start playing out, it makes you more hesitant to take the original trade that you were going to take. Any trade that makes you slightly hesitant like that, it's probably better off if you don't take it. That will increase your win rate. The next thing, waiting for appropriate price action before deciding what to do. Last week, I was calling out this trade right here that we were looking to take. There was a break of this super clear support zone. Price had come back up to retest this support zone as resistance, but found no resistance at all right here. It just ended up spiking right up through this zone. So if we would have just taken this trade, if we would have just sold right here, trying to anticipate that, hey, this outcome is going to play out, this little retest up here, and then price continuing down away from the zone, we would have gotten stopped out on this trade, or we would have had drawdown and the trade would have ended up starting to go back into break even or back into profit or whatever. But if you would have been looking for price action here at this zone, this would have kept you out of the trade. It also helps you get into good trades. So not only can you start avoiding bad trades by looking at the appropriate price action at the levels you're looking to enter at, but you can also capitalize on good trades. So check this one out. This is the trade that I called here in our analysis group. Whenever this was last week. Yeah, it was last week. It was a simple trade. There was this H4 support resistance zone. Price had broken below it. It had come back up to the zone. It had paused at the zone. Then it started to reject this zone, closing right here on the 1 hour with the 1 hour bearish, slightly engulfing candle. It's just a 1 hour bearish candle going away from the zone. So I called this trade out. This one ended up playing out here within a couple hours, ended up coming back down to the previous lows where our target was. And we also would have used an invalidation of this zone if price would have pushed back above this zone and started closing above it. That's the next thing that price action can do, is if you're in a trade and price starts going the other way and it starts no longer being valid and it starts breaking above the zone that you thought it was going to bounce at, you can get out of those trades early at a fourth of the way to the stop loss or half the way to the stop loss, or in some cases 3/4 of the way to the stop loss, without taking a full stop out on a trade that is likely going to hit the stop loss anyway. That is why having an appropriate understanding of price action analysis, which you just get that through chart time and experience and analyzing charts and stuff, it just comes with time, seeing it happen over and over again. But that skill of being able to analyze price action, that goes a long way in not only keeping you out of bad trades, but profiting on good trades that set up appropriately, and also keeping your losses smaller so that if a trade starts to not work out because the price action isn't setting up in the appropriate way, then it allows you to get out of those trades a little bit earlier, therefore decreasing your losses and then increasing your overall profitability. And this last one, I thought I'd just talk to you guys directly here in the camera. So this last one is intuition. So this happens when you've gotten a little bit of applied experience from trading. So after you've been trading for a couple months, hopefully you've been tracking your trades in a journal. If you're not doing this, watch the free training. The link is in the description. I talked there about the importance of tracking your trades and journaling and stuff like that. But you'll start to, as a result of your applied experience, you'll start to see stuff happen over and over that either ends up being winning trades or losing trades. So you may have your objective trading criteria all lined out. The setup may happen literally perfectly on the chart, but there may be one or two things which make you hesitant. For example, maybe you have a perfect setup, but it sets up an hour before NFP news, so non-farm payroll US dollar news. Probably not the best idea to be taking a US dollar trade when all that volatility is about to happen. So that little bit of intuition, as a result of your applied experience trading NFP in the past and getting wrecked, will end up keeping you out of that trade, and that ends up increasing your profitability. So another thing it can be is if there is a break or retest setup and you're about to go in, but then you notice that price has already tested this zone 2 times, 3 times, 4 times, and it's tried to bounce at the zone that you're looking to trade off of, but it's not working. It's tried to bounce 1, 2, 3, 4 times, but it's been failing to go up from the zone if you're trying to buy. That might be a sign to say hey, price has already tried to go up from here. It doesn't look like it's working out easy. It might be better if I just sit out of this trade. That other thing, if you're sitting in a trade and it starts going sideways and it doesn't start easily going into profit, in the past, you can use your experience to say, most of the time when I'm right about a trade, maybe 80% of the time that I'm right, it ends up going right into profit. The 20% of the time that I'm right, it goes sideways and then goes into profit. But 80% of the time you're right, if you know it's going to go right into profit, and then you get into a trade and it starts going sideways instead of going into profit, that might give you a little inkling, that little feeling, that little bit of intuition as a result of your experience trading that tells you, hey, it's going sideways. It might be better if I just close my trade right here. I can get out a small profit, a small loss, break even, or whatever it is. And then that overall increases your profitability because it lets you avoid a loss. For instance, if you would have been on a Euro USD long this morning and had the initial bounce, it came back and had the second bounce right here, but then it had another candle that came and closed below the zone. If you're sitting in a buy right here at this support zone on Euro US dollar, it's probably going to end up crashing down. So using your price action analysis along with your experience trading that gives you that little gut feeling that like, hey, every time this happens, usually it'll end up going to the stop loss, might be a better idea to close the trade. Putting all this stuff together gives you that intuition to go forward in your trading to say, hey, even if everything's set up perfectly on the chart, you listen to that gut feeling you have. It doesn't usually lie. That intuition, provided that you've gotten enough experience and enough data that you've tracked in your journal, is very valuable, and you shouldn't ignore that feeling. That feeling of intuition can go a long way, so use it. I hope you found this video useful. Hit the like button if you did, and consider subscribing if you like videos like these. I release at least one of them every single week to help you in your trading. I've got a link in the description for my free training as well as some of the services I offer, like my analysis group and my full program that comes with lifetime one-on-one mentorship. So if any of that interests you and like to check it out, there's links in the description for all that. Hope you have a great rest of the day, and I hope this video helped your trading. Cheers.